Good day, ABM. This is Mom Jane Atendido, and I'll be your assigned instructor in this course, Business Finance. This is a presentation about the lecture discussion in Lesson 1 with the title Introduction to Financial Management. First, let's define finance. According to Gidman and Zotter, finance is defined as the art and science of managing money. It is concerned with the process, institutions, markets, and instruments involved in the transfer of money among individuals, businesses, and governments. There are two categories of finance: public finance and private finance. Public finance deals with the revenue and expenditure patterns of the government and their various effects on the economy, whereas private finance is a category of general finance which is classified under public finance. It is a money management by an individual or a private entity. It is subdivided into following categories: personal finance, the finance of non-profit organizations, and business finance, which is the focus of this course. Personal finance is concerned with the fundamentals of managing one's own personal money affairs, or your own money. Finance for nonprofit organizations includes private undertakings such as charity, religion, and some private educational institutions. Whereas the term business finance refers to the provision of money for commercial use. It is concerned with the effective use of funds. According to Wheeler, business finance is that business activity which concerns with the acquisition and conservation of capital funds in meeting financial needs or goals and overall objectives of a business enterprise. Also, according to Gottman and Doggle, business finance can broadly be defined as activity concerned with planning, raising, controlling, and administering of funds used in the business. Now, let's proceed with the term financial management. Financial management is also called as corporate finance. It focuses on decisions relating to how much and what types of assets to acquire, how to raise the capital needed or the fund needed to purchase such assets, and how to run the firm to maximize its value or to increase the value of the firm or business. Also, financial management is the efficient and effective management of funds in such a manner as to accomplish the objectives or the goals of the organization. It also means planning, organizing, directing, and controlling the financial activities, such as the procurement and utilization of funds of the enterprise. It means applying the general management principles to the financial resources of the enterprise. The effective procurement and efficient use of finance or funds lead to the proper utilization of finance by the business concerned. It is the essential part or function of the financial manager. Hence, the financial manager must determine the basic objectives of financial management. The objectives of financial management may be broadly divided into two parts: profit maximization and the wealth maximization. Profit maximization is a process of increasing the profit or earning capability of the company or the corporation. It is mainly a short-term goal and is primarily restricted to the accounting analysis for a financial year or within 1 year. It ignores the risk and avoids the time value of money. It is primarily concerned with how the company will survive and grow in the existing competitive business environment. Wealth maximization is the ability of a company to increase the value of its stocks for all the stockholders, or increasing the value of the investment of the shareholders or stockholders. It is a long-term goal and involves multiple external factors like sales, products, services, and market share. It also assumes the risk and recognizes the time value of money given the business environment of the operating entity. It is mainly concerned with the long-term growth of the company and hence is concerned more about fetching the maximum chunk of the market share to attain a leadership position or to be a market leader in a specific industry. Finance functions are closely related to financial decisions, and these decisions or functions are performed by the finance or financial manager. In the course of performing these functions, the financial manager takes the following decisions: financing decision, investment decision, dividend decision, and liquidity decision. The financing decision. Financing decision is concerned with obtaining funds to meet the firm's long-term investment requirements. Meaning, in this function, the financial manager is concerned with identifying or determining the sources of funds to support or to finance the long-term investment requirements of the company. Also, capital structure is the mixture or the specific mixture or ratio of long-term debt and equity, which the firm uses to finance its assets. The financial manager or the finance manager has to decide exactly how much funds to raise, from which sources to raise, and when to raise them. The next finance function is the investment decision. It is a financial decision that is concerned with how the firm's funds are invested in different assets. An investment decision can be long-term or short-term. A long-term investment decision is called capital budgeting decision, which involves huge amounts of long-term investments, and it is irreversible. Examples of these long-term investments are investments in long-term assets such as property, plant, equipment, and expansion for a new building. Take note that a bad capital budgeting decision normally can severely damage the financial portion of a business because of the huge costs of those long-term investments. The third finance function is the dividend decision. The dividend decision involves two issues: whether to distribute dividends and how much profits to distribute as dividends. A finance manager has to decide what percentage of after-tax profit is to be retained in the business to meet future investment requirements and what proportion has to be distributed as dividend among shareholders. Should the firm retain all the profits or distribute all the profits, or retain a portion and distribute the balance? The proportion of profits distributed as a dividend is called dividend payout ratio, and the portion of profits retained in the business is the retention ratio. The fourth function or finance function is the liquidity decision. It is concerned with the management of the current assets, which is a prerequisite to the long-term success of any business firm. It is also called a working capital decision. This current assets that we're talking about is focusing on current assets, inventory, and receivables or account receivables of the company. If a firm does not have an adequate working capital, it may become illiquid or not liquid and consequently fail to meet its current obligations or short-term debt obligations, thus inviting the risk of bankruptcy. On the contrary, if the current assets are too enormous, the profitability is adversely affected. Hence, the major objective of the liquidity decision is to ensure a trade-off between profitability and liquidity. Thus, the liquidity decision should balance the basic ingredients of the working capital management and the efficient allocation of funds on the individual current assets such as cash, inventory, and account receivables. In an organization or in a corporate setup, the finance functions are headed by the Chief Financial Officer or the CFO. A Chief Financial Officer is a senior executive responsible for managing the financial actions of a company. The CFO's duties include tracking cash flow and financial planning, as well as analyzing the company's financial strengths and weaknesses and proposing corrective actions. Now let's proceed with the financial system. The financial system allows the exchange of funds between the financial market participants, such as the lenders, investors, and borrowers. The financial system plays a key role in the economy by stimulating economic growth, influencing the economic performance of the actors, affecting economic welfare. The financial system facilitates a balance between those with funds to invest and those needing funds. According to the structural approach, the financial system of an economy consists of three main components: the financial markets, financial intermediaries or institutions, and the financial regulators. Each of the components plays a specific role in the economy. According to the functional approach, financial markets facilitates the flow of funds to finance investments by corporations, governments, and individuals. This market pertains to a marketplace where the trading of securities occurs, including the stock market, bond market, forex or foreign exchange market, and derivatives market. The next financial system component is the financial institution. Financial institutions perform the function of intermediation and thus determine the flow of funds. They act as a middleman between the lenders and the borrowers. The example of these financial institutions are the bank and non-banking institutions. And the third component of the financial system is the financial regulators. They perform the role of monitoring and regulating the participants in the financial system. In Philippines, stocks are monitored by the Philippine Stock Exchange. Now that we are familiarized with the financial system components, let's now proceed with the term financial assets. Financial assets is also called as the financial instruments. These are intangible assets which are expected to provide future benefits in the form of a claim to future cash. Some financial instruments are called securities and generally include stocks and bonds. In any transaction related to a financial instrument, it always includes at least two parties: the issuer and the investor. The issuer is the party that has agreed to make future cash payments. The issuer is also called as the debtor of the transaction. On the other hand, the investor is the party that owns the financial instrument and therefore they have the right to receive the payments made by the issuer. The investor is also called as the creditor in that particular transaction. Lastly, financial assets provide the following key functions. First, they allow the transfer of funds from those entities who have surplus funds, or the creditors or investors, to invest to those who need funds to invest in tangible assets. They also redistribute the unavoidable risks related to cash generation among deficit and surplus economic units. Thank you, and that's the end of our presentation. For questions and clarifications, you may directly communicate with me through my Messenger account or on our group chat for business finance. Once again, thank you.